Hi, I'm Patu from TreeFinCal. In today's video, let's take a look at the valuation of the Nifty and also the Nifty 500, and let's find out where we stand. And when I looked at the numbers, it seemed as if the market didn't even crash, or maybe even if it crashed, it looked as if it has recovered already. But that's of course as on May 15th data. Today, May 18th, the market fell down another 3.4% or so. The Sensex or the Nifty fell down that much. So, I mean, this is an evolving situation, but as on the May 15th data, this is how it looks like. So, let me get rid of my face. We'll come back to this later on. So, what you see here is the Nifty PE. The PE ratio is basically the price of the Nifty divided by the weighted average earnings per share of the Nifty. That's those blue streaks that you see here. This red line that you see in the center is a 10-year moving average of the PE. So this is one standard deviation above the average, two standard deviations above the average, one standard deviation below the average, two standard deviations below the average. So higher the PE ratio, higher the price compared to what the stock is worth in terms of what it's earning. That is, it's a valuation metric, and a low PE means compared to what the Nifty stocks are earning, the Nifty is priced at a low value. So you can see here that since about 2000, I would say 16 or so, the Nifty P shot up, and then from 2017 and most of 2018, 19, it was hovering between two standard deviations above the 10-year average and one standard deviation. And then in early 2020, it from close to two standard deviations above the average, it crashed all the way to one standard deviation below the average, a little bit more than that, and then it immediately recovered to the average, the 10-year average. So the Nifty is actually trading today at its more or less close to its 10-year average. You can see this. I'm not sure where my image went. Yeah, you can see that. So that's my. Let me just make this a little bit smaller. So that's the value there. You see it crashed all the way there, and it's straight close to its 10-year average. That's not how it looks like after the crash, and we're still not recovered fully from the crash. So it's still fairly valued. So the Nifty is not cheap, and that's a worry. The next is the Nifty price to book value. So the price to book value is the price of the Nifty divided by the book value of the Nifty. That is, if all the 50 shares in the Nifty were completely sold off, what would they actually be worth? That's the book value. So again, high PB means that the market is overpriced, low PB means market is underpriced, and you can see here the market was one standard deviation above the 10-year PB average, but it crashed and is now trading at about actually two standard deviations below the average. So if you actually look at the market in terms of the price to book value, the market is fairly cheaply valued. I would say it's a very low PB. But then if you look at the PE, it's fairly valued. So it's a very confusing signal. So we need to go beyond this. So next we can do is calculate the return on equity of the Nifty. This is done by taking the PB value and dividing it by the PE value. So this would give you earnings per share divided by the book value of the Nifty. So what are the earnings per share compared to what the Nifty is actually worth in terms of book value? And notice that after the 2008 crash, the return on equity, this is also called book yield, the return on equity of the Nifty has been continuously falling. This is the reason why I have been talking about this. The long-term returns of 10-year returns, 15-year returns of Nifty has been falling and falling and falling. Almost by 50% it's fallen down. Notice in the crash, in the bull run between 2002 to 2008, before the 2008 crash, the bull run was accompanied by a nice, a fluctuating but gradual increase in the return on equity. But then, since then, the return on equity has been continuously falling. So, in that term, the market, the bull run that we saw from late 2013 to 2019, more or less, that kind of bull run without big crashes, except maybe August 2013 there was a fall. Except for that event, during that time there is really no return on equity, and I've mentioned this several times. The market has been moving up on fluff. There's no real basis. There's no real corporate earnings that has been coming, and this is a sign of the recession, I would say, that's been setting that's been setting in the industry. And now this economic lockdown is going to make this worse, and so that's actually a bad. I would say that's a bad thing. Notice that if you look at the PB by PE, there's no sign of the crash. The crash is not even visible. That shows how. I mean, I don't know. That shows the lack of ROE in the market even before the crash. Nothing is. It's almost as if nothing has happened. That's really bizarre. Now you can take the dividend yield, which is the dividend offered per share, but the dividend yield will not take into account the earnings that the company has got, but not as given out as but has not given out as dividend. That is, the retained earnings will not be factored in by the dividend yield. So what we do is to calculate the inverse P, that gives you the earnings per share divided by the price. So that gives you, basically that acts like a yield from the yield from equity. So you can compare it with the 10-year bond yield. So you have two yields to compare, and you now have this is 1 by PE is called earnings yield, and that 1 by PE, notice in 2008 the interest rates crashed and the yields basically crashed by a huge amount, and the earnings yield actually shot up. That means that the price became so low that the earnings yield increased. Now you can see the earnings yield increased in 2020 crash, sorry, but then it fell back again. So, and this can be better visualized in what is known as the yield gap. So this yield gap is basically the this is 10-year gilt yield divided by 1 by PE. That's called the yield gap. So this yield gap is a measure of bond yield divided by equity yield. So you can see here, if the yield gap is less than 1, that means that the equity yield is much lower than bond yield and you can invest in equity. But if yield gap is greater than 1, that means bond yield is greater than equity yield and it's not favorably valued. Notice that in 2008 crash, the equity yield dropped to about 0.6. Then equity was available at a very cheap price. I mean, the equity yield came down so much that it was a good time for you to invest in it. But now you can see that the yield gap is, sorry, did I say that right? So this is, yeah, no, the equity yield actually increased so much. So, sorry, it's, I said it wrong. I mean, so the yield gap is basically 10-year gilt yield divided by 1 by PE. So during the 2008 crash, the bond yield fell down and the equity yield increased so much that was a favorable time to invest in equity because the prices have gone down so much. And so that is what is shown here in the yield gap. So the yield gap less than 1 means that's a good time to invest in equity. And notice that it has not been less than 1 since 2008, and in this 2020 crash, it never hit that 1. It has always been, even when it crashed at the worst time of the crash, March 23rd, the yield gap was greater than 1, and now it has increased even more. So the equity is not favorably valued; it's still overvalued. So it's hard to call this a crash from this point of view. It's more of a correction. And you can also plot the same yield gap for Nifty 500 data. Again, the Nifty 500 data is comfortably well above 1. It's still, I would say, fairly valued, or it's a kind of 50-50 kind of investment between equity and bond. It's not attractive. Equity is not attractive enough in terms of cheap valuations. If you look at it from the point of view of cheap valuations. So going ahead, I'm a little worried about this lack of ROE. I've been saying this for many times before. The lack of ROE, the market has still not corrected enough to actually say we are in a crash from these metrics, for using these metrics. So it's going to be a tough time. I've been saying we're gonna face a very rocky market for some months to come. Please don't put your money into equity for short-term goals, for 3 years, 5 years, even 7 years, I would say don't put into equity. For 7 years at least, you can have 20-30% exposure, but for 5 years, 3 years, please don't put into equity. Anyway, it is risky. Now you have one more reason why it is risky. So please be careful. And I have a tool. I have a market timing tool. You can go to freefincal.com and you can see this Nifty valuation tool, and you can use this Nifty valuation tool to create the graphs I have done yourself. So thank you. Bye bye.